Hello and welcome. India's economy, like it or not, is at crisis point. We are at our lowest point in at least the last 20 years. What happened to that great Indian dream of just 2 years ago? Have we moved from a breakout nation to a breakdown nation in just a few months? With due respect to Ruchir's book and his phraseology. The rupee has collapsed. The stock market is falling, industrial output is stagnant or in decline, unemployment therefore is rising, and the escape from poverty will now take much longer like this. So the question is this just a temporary cyclical problem, or are we going to face a long-term crisis? Ruchir Sharma, the author of the hugely successful book, The Breakout Nations, and Arun Shourie are both with me to try and understand in a non-partisan way what exactly is broken in our economy, why it all went wrong, and who is to blame. We should also try and look at what should each one of us do now to protect our savings, our income. But first, how bad is it really? As we shall see in a few minutes with some of Ruchir and the Morgan Stanley graphs, things are really bad. If we carry on like this, India will be declared junk status. This junk status rating could even happen, some say, in less than a year from now. There is even a possibility that India will have to go back to the IMF. Remember, India today has $170 billion in short-term loans to repay by March next year. $170 billion is a mammoth short-term debt. Can we repay that without a loan from the IMF? Any loan from the IMF, of course, comes with all its tough conditions. In this program, we'll also look at what has caused this problem. How much of this crisis is global and how much is local? Now, there's little doubt that the immediate reason behind the money flowing out of India to America is that the US economy is doing much better and investors are flooding back there. The tide of money is flowing from all emerging markets, developing countries, back to America. Everything was sort of fine as long as America was doing badly. Money flowed to India and other emerging markets, other developing countries. We were all swimming along on the incoming tide of dollars. But there is a saying, when the tide runs out, only then do you know who was swimming naked. Well, the tide has run out, and India, I'm afraid, has been caught with its pants down, so to speak. Now, there's nowhere to hide anymore. With the ebb and flow of the tide of dollars, many see a parallel rise and fall of India's economy. But let's have a look at the dollar and the rupee exchange rate and see how the rupee has plummeted. And it's really happened in the last 3 months, since May. These are some figures put together by Ruchir. You can see from the beginning of that graph is about 2007. It's more or less flat, and then since May, the sharp decline. How low will it go? Ruchir, this decline we've seen just seems to get worse and worse every day.
Well, I think this is the issue with currency panics, that once they start, you really don't know as to where they will stop. Because on any valuation metric, it appears that the rupee now is somewhat undervalued and definitely not overvalued like it used to be a couple of years ago.
Right.
But the issue with currency panics is that you never know as to when they will stop or how much you have to undershoot the fair equilibrium before you get some sort of reset of confidence.
Right. Let's just have a look at one of the reasons that your data shows,
right,
and your team's data shows on why the rupee has fallen. Let's have a look at the outflow of money from India in the last 3 months. This is what it looks like. Now, this is the FII equity. It had gone up this year by $14 billion, and it just came down since May by $2 billion. But what about FII debt? Let's have a look at that. It went up by $6 billion this year, and it's gone down since May by $10 billion. So we have seen $12 billion going away from India in the since May, and that $10 billion debt has gone to debt in America. FDI, foreign direct investment. Just look at what's happened. 2008, Foreign direct investment was 48 billion. 2013, it should be growing because our GDP is growing. It's 27, almost half of what it was. India is becoming more and more dependent than ever on foreigners, on foreign money coming in. Let's have a look at what's called the current account deficit. Broadly, this is our imports being more than our exports plus some remittances. The gap, the negative gap in 2007 was $8 billion. Today, it's $90 billion. Just broadly think that your imports are $90 billion more than your exports plus remittances. That is a huge gap. And what's worse, if we look at how this can be covered by our foreign exchange reserves, if you have lots of reserves compared to your gap, this current account deficit, you feel a little confident. What were our foreign reserves in 2007? 300 billion. And today, down 275 billion. Now look at that. In 2007, $300 billion worth of reserves were covering an $8 billion gap. So you felt, confident, you were on top of the world. But now, $275 billion in reserves are only covering a $90 billion gap. One other very worrying, most vulnerable area that India is facing right now is our short-term debt. Now, long-term debt you can live with a little bit, but let's have a look at the short-term debt. 2007, it was still pretty high, 80 billion. But look at that now, 170 billion. Okay, I just want to see some of the implications of such a huge short-term debt. Let's get down to a little more micro level. How is it affecting Indian companies? And Ruchir and the Morgan Stanley team have looked at some of the top 10 Indian companies that are deeply in debt at the moment. And it is quite frightening. Look at that. In 2007, these top 10 companies were 1,000 billion rupees in debt. Now it's 6,000 billion. There's companies up to 6,000 billion rupees. The interest payment on that must be enormous, Ruchir.
Yeah, in fact, 25% of Indian companies, by some estimates, today do not have sufficient cash flow to make their interest rate payments. 25% of Indian companies. 25% cannot pay,
they're not earning enough to pay their interest even.
That's right. In terms of, that they have a negative interest cover is what we call it. So that's a real problem. In fact, I think this has been one of those underanalyzed, underappreciated facts about what's really going on, which is that corporate India is in deep trouble because they had leveraged and taken on a lot of debt over the past few years.
Look at that, 1,000 to 6,000.
Yeah, and it's very concentrated because you find that some of the large corporates have a very large share of it now compared to what, and a lot of this has been taken on the external front. So corporate debt in India over the last 5 years has doubled.
The corporate debt, how much did Indians invest abroad, Indian corporates? 2008, they invested 21 billion abroad. This year, 7 billion. Instead of growing, it's less. So they don't have the money.
Exactly.
That's what the point you were making. That it's not just foreign money coming. Indian corporates are also in not good shape at the moment.
Right.
I wanted to move on now to one more thing. This current crisis, global versus local. How much is it a global and how much is it our local, as you say, Swadeshi problem? Let's have a look at, say, on the currency devaluation. This is just a sample of countries. China currency has gone up. Mexico just down -1%. And Mexico has put in a lot of reforms. Indonesia -8, Russia -8, India -16, Brazil and South Africa below us. But we are at the bottom 3 in this. Let's move on to the next one. Where is our pecking order in terms of the stock market? Mexico again -2, China -7, -10, -13, South Africa, Turkey -14, India and Brazil 17 and 20. Again India near the bottom. So when we see that India is kind of pretty low down on the pecking order in devaluation in the stock market, why is this happening? What's the reasons for this? Why is India at the bottom of the heap? Let's have a look at our fiscal deficit, something Arun was just talking about. Fiscal deficit as a percentage of GDP, India is rock bottom. Now this is a fundamental problem with the economy. And as you were saying earlier, Ruchir, this doesn't happen at states. This is at the center.
Yes, because the states also have a deficit, but it's under control. It's sort of at an average of 2.5% of GDP. These are central numbers for all these countries, and you can see at the center we do much worse than other countries. So this is the problem with India. It's spendthrift ways.
And let's have a look, in fact, at our current account deficit. That's again a cause. And this you could have seen a long time ago. Why is India at the bottom of all those charts? Just look at another reason. Apart from the fiscal deficit, the current account deficit. Again, this is data compiled by Ruchir and the Morgan Stanley team. Look at that. Russia, current account deficit plus 2.3, China 2.3, Mexico just 2, India 5, only South Africa and Turkey. I'm surprised Turkey is so low. But we're still again near the bottom. So this 5% is unacceptable if you're wanting a long-term equilibrium and growth in the economy. This is a worrying sign. What's the bottom line? First, yes, this is the worst economic crisis in 20 years. Maybe even worse than 1991 in certain respects. But thank God, at least for a good monsoon this year. Hopefully food prices at least will not rise this coming year because of a wonderful monsoon. That's God we have to thank for that. Second, I guess, on the question of who is to blame, is it a global problem or a homemade local problem? Well, frankly, according to what I've heard today, it's probably 50-50. There is a global flow of dollars away from emerging markets, away from developing countries towards America, as the US economy has started doing well. But then, why are some developing countries doing better than others, like Mexico? Why is India doing almost the worst of all? So, there is 50% our fault. And as I said at the start, as the dollars started flowing out of developing countries, it's like the tide flowing out. And while the tide is high, everybody swims happily. But when the tide flows out, you get to see who's been swimming naked. And that's what's been revealed about India. Yes, we have been treading water for the last 5 years, doing nothing. The lack of reforms over the last 4 or 5 years is now, unfortunately, with the tide being exposed. Unlike Mexico and others who've brought in huge reforms and are doing fine even without that inflow of dollars. So while there is undoubtedly a global problem, still at least half the blame must be with our policymakers. Whatever happened to that dynamic trio of our economist prime minister, the brilliant Montek Ahluwalia and the finance minister? What happened to their spirit of reform in 1991? They must all accept some blame for the current crisis. Thanks for watching. Bye-bye.